Hello everyone, welcome to another Reuters Events webinar. This is on ESG data. Today we have a great lineup. We have three fantastic speakers: Joseph Lake, the COO of the Climate Service; Abigail Dean, who's Head of Sustainability at Nuveen Real Estate; and Nikita Singhal, who's Co-Head of Sustainable Investment and ESG at Lazard Asset Management. So today I want a really interactive webinar, so please do feel free to send in your questions. What we're going to talk about today is we're going to talk about a couple of the drivers of ESG data, but then we're going to get into the challenges, and the guys have got a number of challenges that they've experienced through their own work, as well as the solutions that they've gone through, bringing through examples. But please do send in your own challenges, send in your own questions and comments throughout, and we'll try to get to as many of them as possible. So I'd like to invite our panelists to give a brief introduction, starting with Joey, if you want to give a brief introduction to yourself and a bit of the work you've been doing in this area.
Sure, thanks so much, Dom, and thanks for the invitation to join the panel today. I'm excited to be here, mostly because I learn something every time I listen to Abby or Nikita. So, as you said, I'm the COO of the Climate Service, and we're a 2.5-year-old software as a service company, and we help investors to measure their risk from climate change. So in this big ESG space, we focus only on the E, and in fact only on a subset of the E. So we're not measuring your impact on the climate, but rather we're measuring the impact of climate change on your investments or on your business. And just as I finish my introduction, I'm joining you today from the US, and there's only one thing that everybody here can think about or talk about all of this week, and it'd be wrong not to use this platform today to spread that message, which has brought millions of people into the streets over the past week. And also because we're here today to talk about ESG, and systemic racism is an ESG issue. So I'd like to just also say that Black Lives Matter. And as former President Obama said yesterday, I sincerely hope that this proves to be a transformative time and that these protests for equal human rights lead to change. Thanks.
Fantastic, and absolutely we reiterate that message of Black Lives Matter. So Abby, would you like to give an introduction now?
Yeah, sure. Thanks, Dominic. And yeah, also like to reiterate what both of you just said, really significant, important issue. So my role is Head of Sustainability at Nuveen Real Estate. And what that means is that I'm looking at how we incorporate sustainability into the investment process for acquiring, managing, and then selling real estate. Nuveen Real Estate, if people are not familiar with it, we're one of the largest investors in real estate globally. We have just over $120 billion worth of real estate around the world, and we are developing that, buying it, holding it often for quite a long period of time, improving it, and then selling it. And sustainability has a key part to play all through that process. So I'm looking not just at the environmental factors, but at social and governance factors as well. And they all have a really important part to play. But within, probably from a data perspective, what we spend a lot of our time doing is looking at environmental data in particular. And there we're mainly concerned with two really significant issues. And that is, what is the risk of physical climate change to our real estate? How can we understand what that might look like in the future? And how can we understand what impact that might have on its value, and then also looking at the impact that we have on the environment. So looking at things like the energy consumption in our buildings, also water consumption and waste generation, and turning that into our carbon footprint, and understanding what impact we have and how we can minimise that, and what that means as we transition as a world to a low carbon economy. So data plays a really important role there as well. And it's important that we have a good flow of information about that to help us in our investment decision making.
Fantastic, thank you for that. Nikita?
All right. Good morning, everyone from New York. My name is Nikita Singhal, and I'm co-head of Sustainable Investment and ESG at Lazard Asset Management. It's about a $200 billion plus global diversified asset manager, both in equities and fixed income space. And my job really is kind of for us to execute on this inherent belief that sustainable investing is smart investing, and to make sure that we do that in a rigorous manner, in an authentic manner, and use it to advocate for change as well. So we kind of have 3 pillars for our strategy. One is that of integrated research, kind of as Abby said, exploring the risks and opportunities that emerge that are material to long-term financial performance. The second is that of impactful ownership, which is to say that we're not, ultimately we are managing the money of individuals, of firefighters, of policemen, of nurses, of pensions we're managing, and it's therefore incumbent on us to think about what that stewardship role entails. And so thinking about engaging with companies and being intentional about our proxy voting is a key pillar. And then the last piece I would say is just a commitment to continuous innovation and a recognition that although I and most of us here have, we've been in this space for over a decade now, or in some cases more, it is still very nascent relative to the larger financial system, history of the financial system. And so there is a need for significant investment in this space and a need for continuous innovation, both of which we're committed to.
Fantastic. Thank you, Nikita. So I think we'll start with the conversation around the drivers of ESG data. I'm going to launch a poll for our audience, but whilst that's going on, Joey, if I could come to yourself and just understand your thoughts on what's driving the increased interest in ESG data right now.
Sure, I think there's sort of several factors come to mind. I don't want to influence anyone's polling choices, but I guess I might do. There's been a real significant increase in acceleration we've seen even over the last 6 to 12 months, and I'm talking here primarily about climate risk data. And there have been 3 factors that we can see that have driven that from our different conversations that we have across the investment community, but also directly with Fortune 500 companies as well. And the first factor driving this is certainly regulation. And I think primarily that's the main factor in Europe. It varies by geography. But in the area of climate risk, the Task Force on Climate-Related Financial Disclosure, the TCFD, has really moved a lot of people. And I have to say, initially I was quite skeptical of things like this. I've spent my entire career in risk management. And when a group of well-meaning people put together a task force at the direction of the G20 or so, oftentimes they come up with really great ideas, but if they're not mandatory and they're just guidelines, everybody sort of politely applauds and goes back to work business as usual. And that's not what we've seen with the TCFD. With the TCFD, we've actually seen a real effort and energy and commitment from now over 1,000 of the world's largest organizations. So regulation is definitely a big factor. I think the second one that I would point to is investor pressure, and this is increasingly driving decisions around ESG data, and particularly in the US. We saw an incredible upsurge in phone calls after Larry Fink's letter in January saying that TCFD and SASB are really the sort of the frameworks and the standards that they're looking to for the companies that they invest in to adhere to. And when the world's largest shareholder, who has $7 trillion of assets under management, says something like that, again, in the past I might have been a bit skeptical, this is just a letter, but we saw the consequences of it as the phone just didn't stop ringing saying, how do we comply with Larry's letter? So investor pressure is definitely a huge factor. And the third one, and this is the most worrying one for me, is the losses that are being experienced from climate change, which is already in effect. So, I mean, there's any number of examples here, but there's an increasing amount of financial and economic losses each year from the increased frequency and severity of catastrophic events, flooding, hurricanes, etc. And if you're not factoring that into your investment decisions at this point, then I think you're doing a disservice to your company and to your shareholders as well. So they're the 3 factors that we've seen sort of driving most of the interest.
I would completely agree, Joey. And I mean, the way I would think about it is or just add to that. I mean, the color, the desire for asset owners, and that therefore putting pressure along the value chain, especially on investment professionals, to both improve investment outcomes, because a lot of sustainability considerations, particularly climate change, but also increasing social inequalities, these are market considerations. These are issues that are increasingly getting priced into the market, and if we are not making an effort to understand its implications, we're just not being good investors. And I think second is the desire from clients to broaden the mandate and to think beyond maximization of shareholder returns. We've seen this kind of shift in rhetoric, I think, with the Business Roundtable, the comments that came out of the Business Roundtable last year, and a desire to think about a more an examination of a broader set of stakeholders in assessing their the relationship and their well-being as part of a requirement for long-term financial performance. And so I think that increased recognition is then starting to translate in different ways in different regions, but in Europe more so with regulation, in the US more so with changes in consumer behavior, and for us the consumers being our end client, our asset owners. And then you're seeing these collaborative organizations that you spoke of, Joey, with it's amazing to me to see PRI's journey, the Principle for Responsible Investing, and what they started out with, and now they have north of 2,800 members, over 20 trillion in asset owner AUM. One, I guess, last thing I'd say is on the asset owner side is we're not just seeing these aren't just numbers that we're seeing in reports. It's actually translating to the conversations we're having with some of our most important clients. And so as an asset manager, we work with a $500 billion Northern European pension fund. They have launched a Sustainable Development Goals platform and have committed to over 50 billion of their AUM focused on sustainable investing. There's a similarly a $10 billion Scandinavian mutual fund company that has committed to over 50% of its AUM being sustainable by the end of this year. And this is not just true to Europe, but we've heard commitments from GPIF, the world's largest pension fund in Japan, and similarly in Australia, our $30 billion superannuation fund now has a specific climate transition fund where, regardless of what your strategy is labeled, ESG, non-ESG, traditional, sustainability, they are putting you on a budget. So they are putting all of their asset managers on a budget, on a carbon budget, and that they have to manage to, because they recognize that these risks cannot simply be diversified away from, and they're systemic in nature.
Yeah, I wasn't surprised to see that investor pressure came in as overwhelmingly the top one in that poll. Certainly, like Nikita, we've seen investors really push this up the agenda in the last few years, and for many of our investors now, it's a sort of table stakes issue. So if we aren't able to demonstrate really strong performance on ESG, then they're not interested in working with us as an asset manager. As an investor in real estate, we take part in something called the Global Real Estate Sustainability Benchmark, which anybody listening who works in real estate will probably be familiar with, and our investors have expectations of how well we will score in that survey each year, and expect to see us improving our performance and getting up to the top quartile performance in that benchmark. And we see that particularly from investors in Europe, Scandinavia, and the Netherlands being particular leaders, Australia as well, and also Japan. And that's growing and growing, and we expect to see it becoming, for those investors that are not focusing on it now, we think it certainly will. And I think that the second is profit, and that will really start to push up in the coming years. Real estate is a long-term investment, and therefore I think that the environmental performance of real estate already plays quite a significant role on its value, and buildings that, when we look to the future, we know that buildings that are greener and are more energy efficient and are more able to make that transition to low carbon economy will hold their value better, they're less risky as investments, and also buildings that are more resilient to climate change. So it's not just about doing good, it really is about protecting value and ensuring that we're investing in the assets of tomorrow.
Fantastic. Thank you all. Has anyone got anything else they want to add there? Joey, I know you didn't get a chance to see and speak once the poll was running. Have you got to see the poll and the results, the overwhelming investor pressure?
Yeah, not a surprise, I guess. Just maybe building on what Avi just said, it's been really interesting for us to see where people start to incorporate this type of data, because it's not equal across all the asset classes. And as Abby said, real estate, it feels quite visceral and quite relevant already. So if you try to account for climate change data, if you're not accounting for it in real estate right now, I mean, you're really missing something quite major. Like if you own a portfolio of property along the coastline of Florida, and you're not accounting for climate risk in how you measure the risk in the portfolio, you're really missing what I call the largest idiosyncratic risk in the world that is still unmeasured by most investors and capital markets. So like Abby said, this is not just about doing good. This is about being responsible investors and accounting for all of the risks that are out there. And I've spent my career, as I said, in risk management, and it's astonishing to me when I sort of turned on to the climate risk conversation a few years ago, that when I realized the materiality of this, like the data is really clear on this materiality of this, and that people are not capturing it when they go to all measure and manner of methods to capture things like political risk and sovereign risk and macro risk and everything. It's really quite astonishing that some investors are not trying to do this already.
Excellent. We've got quite a few questions here around social issues, and I know I think Abby, you wanted to raise something about the availability of social data. But the question here is around, do you think investors are going to begin to looking into social issues and impacts more substantially now with the whole Black Lives Matter movement and the events of the previous week? And we could also, I guess, bring in the implications of COVID-19 into this and the various effects that that's had on the labour market and on employment and so forth, and governance issues such as executive pay.
Yeah, I think that's a great question, and I really do think that the events of the last weeks and also the COVID crisis have brought the S in ESG, the social issues, to the fore. We have, as a globe, years ahead of us to rebuild our economy, and we have some choices about how we do that. And I think a lot of investors are thinking about how can we responsibly invest in that economic growth, and what factors do we need to look at to ensure that economic growth has longevity and has sustainability built into it. So that means that factors such as tackling social inequality, tackling systemic racism, looking at job creation, and creating a sustainable long-term growth is going to be really fundamental. This, I think, was a trend that was already building. We saw impact investing with a rising focus on some of those issues emerging as a significant trend in the last few years. And I think that the COVID crisis in particular will really accelerate interest in that theme and really grow that. It's certainly something that we're actively looking at impact investing strategies at the moment, because we can see that there's a real demand for it from our investors who want to understand what positive social impacts their investments can have and want to have criteria around that alongside financial return criteria.
Yeah, I might just add on to that, Dom, if that's okay. Just in the part of your question that related to COVID-19, I think that there was a lot of questions around what does this mean for ESG and investment decision making, and will this set us back in this journey that we're on? And we have been, again, we get to see a lot of different sectors and types of investors and how they respond to things like this. And I've been really surprised, to be frank, at the response, because I think this has actually sort of made more people aware of the risks that they face right the way through, from the supply chain in the company through to the operational effectiveness of the company itself and through to the market. And we've seen, again, some of the sectors that have been most impacted by the economic fallout here, like airlines, oil and gas companies, who have said we need to come out of this stronger on climate risk. Actually, this sort of reinforces the work that we were already doing, and so not sort of pulling back investment in this sort of difficult economic time, but in fact reinforcing that investment in this area.
Great. Just while you're speaking then, I just loaded that question up into the poll because I thought it might be interesting to gain the audience's view. And we've just got enough sort of responses in, so I'll show that now. I don't know if that is surprising to anyone. Yes, but not substantially. I don't know, any comment on that?
I think one of the challenges. Go on, Nikita.
Go ahead, Abby.
Well, I was just going to make a quick point that I think the part of what might be driving the yes but not substantially piece is certainly it's quite challenging to actually find the data and the metrics when we look at social issues. So for environmental issues, it's quite obvious what things you want to be looking at. You want to look at carbon emissions, you want to look at recycling, you want to look at pollution and waste. And those things, whilst it can be difficult certainly to get the data, once you have it, it's easy to quantify it to a certain extent. Social issues, it's much more difficult, and I think that means that it's not quite as obvious how we might incorporate that into investment decision making. So I think that might be part of the reason why we haven't seen as much prominence on that S as we have on the E in the past.
Fantastic. So we can move now onto the challenges that we wanted to bring up and to look at and to address in some way. So Nikita, I'd like to start with you, if we may, talking about the availability of data, the deluge of data, and the evolution of disclosure. I think we're having a little bit of technical difficulties. Is that for everyone, or was that just on my end?
I think that Nikita's internet might be acting up a little.
Okay, well then perhaps Abby or Joey, do you want to jump in there with the availability of data question?
Yeah, I'd be happy to sort of start the conversation on that. And I guess if I can split the answer into two pieces. So one, the availability of data and how to capture it. And the second piece being, what's the most useful way to use this? So we, as I said, we look at both physical and transition risks from climate change. And the modeling around that is really quite complex and requires deep scientific and financial understanding. So we have this framework of hazard, vulnerability, financial risk, which is a traditional framework used by the insurance industry for decades. So what types of hazards do you have? Will we have in the future? What's the vulnerability of each asset or investment to those hazards? And then couple those two together to produce a risk or an output or metric in financial terms, because that's what matters to investors. We've become more sophisticated now in the area of climate data. It's no longer good enough to have a risk score or heat map. You want to understand, what does this quantified mean for me in financial terms? And so there's a ton of data that we need to capture in that. We have over 30 different climate models that are really easy to understand if you've been working in climate science for your entire career, but less so for investors, I guess. And so the two co-founders of the Climate Service spend their lives at this intersection of climate and big data and technology. We have an advisory board which includes 4 of the IPCC Nobel Prize recipients, climatologists who worked for NASA and academic institutions, etc. So I guess the sort of reason why our two co-founders started this company 3 years ago is because they recognized that almost nobody can afford to hire all of those sort of PhD climatologists, etc., to build this type of model themselves. And so we wanted to sort of put that together and provide that service to everyone to democratize access to this type of data. So that's the sort of all of the data.
I seem to be having some trouble on my end.
I think some of Nikita's words are coming through now on the so the second part of this question is sort of, how do you use that data? And I guess this is sort of really well established. Sort of scenario analysis is the best way to use this type of data. We use scenario analysis for all sorts of macroeconomic risks, for political risks, but there is some skepticism around And I can keep full now. There's some skepticism, I guess, around climate models and how well accurately they'll predict the future. And I guess that's the wrong question to be asking. It's about models, different scenarios out in the future. So what do your investments look like if the world were to warm by, say, 2 degrees Celsius on average, versus what would your investments look like if the world were to warm by 4 to 5 degrees Celsius on average? And so, again, my previous background in sort of political forecasting and so on, almost every major political forecast of the last few years has been incorrect, whereas the climate models have been more or less accurate for the past 40 years. So it's a difficult, complex task, but it's the same sort of framework that we've used to model other types of risk. And what we're seeing, the results of that now have been really helpful to investors.
I agree with Joey that scenario modelling is a really helpful tool when it comes to climate risk in particular, and also looking at that, both the physical impacts of climate change and what will if we're looking at investments in a certain location, what will the impact of 2 degrees of warming look like over the next 20 to 30 years? What will that mean in terms of number of the likelihood of severe storms, of flooding, of wildfire, what are the likely implications of that for different real estate in different locations? What are the impacts on tenant industries if we have got lots of tenants who've got supply chains in other areas that might be subject to climate change risk? Having a look at it from that perspective as well. And then looking at other climate scenarios as well. I think it's also a helpful tool when we're looking at the transition piece as well. So looking at the scenario of a very fast and sudden transition, something that we think is a possibility is that we might have a very sudden regulatory response when the reality of climate change starts to become apparent. And what will that look like, and how can we prepare for that? Compared to a more gradual response. So yes, scenario modelling really comes into its own, I think, when we're looking at that. To go back to your original question, Dominic, around the amount of data and how to deal with that, I think that is a real challenge with ESG. And for us, the climate risk data is one area that we're looking at, but we're also looking at data around construction and data around the embodied carbon there. We're looking at operational performance of buildings. We're looking at the socio-economic impact of our buildings on local areas. So there is a huge amount of data, and I think for each individual investor or asset manager, being able to undertake an appropriate materiality analysis and identify what are the really significant pieces of information that are going to have an impact on value for assets is the key task, is being able to get access to that data and use it in that way. Outside of our real estate business, we have a responsible investing data platform which brings together huge amounts of data from a range of different third-party providers, along with our own proprietary data analysis. And that means that our analysts have a dashboard of information around all different asset classes that we invest in, and being able to use that information and compare it against more traditional metrics, we think really gives us a unique edge. But there is a huge amount of work that goes in the background to really formulating that platform and making it workable. It's not something that you can get to without doing that groundwork. I think we might have Nikita back.
Hi, Nikita.
Hi, sorry about that. There seems to be some tech issue going on. Can everyone hear me now?
Dom, can I just add on to what Abby just said, just quickly, because I think this is a really interesting example of how sophisticated this analysis can get, and I think Naveen has some of the most sophisticated sort of climate risk understanding that there is. But when you think about physical climate change. And this might be, I think a lot of people are at different parts of this journey here, right? So not everybody is at the sort of the sophisticated understanding that Naveen has, but people are starting out in this journey and unsure of where to begin. So as an example here, when you think about physical climate risk, and I mentioned earlier on about the sort of portfolio of property along the coastline of Florida, and just in very basic terms, like the increased flooding could mean that those homes could be underwater, both figuratively and literally within the investment time horizon, right? And so that's the risk at a very basic level. But then you start to move on to the next sort of second order effects, or a more sophisticated understanding. So not just direct building impacts, because that can sometimes be relatively small compared to the market value of the asset, because many costs can be passed through to tenants or covered by insurance. So we're also looking at things like rental market growth, municipal level adaptation, and other market level factors that can be affected by climate hazards. And then finally, you also can have tipping points, which you then need to incorporate. So at the moment, we're working with one of the world's largest insurance brokers, which will announce that collaboration in the next week or so, to explore how climate-related tipping points will result in financial impacts at the market level. So an example here is the availability of certain types of insurance policies and the prices of those policies. So once one of these hazards reaches a certain point, let's say the increase in the annual probability of significant coastal flooding events, going back to that example in Florida, at some point insurance may no longer be available. So you need to be aware of those tipping points as well. So what starts off as this is a pretty basic risk, quite easy to measure, you start to see the second order effects and the third order effects, and that's when it gets really interesting, I think, and really quite complex.
Yeah, if I'm kind of following through on the conversation, I would say that I think one important learning for us in our journey in terms of understanding and incorporating ESG data is the realization that it is highly contextual. And we've talked more broadly about climate change issues being systemic in nature, but the manifestation of them can vary quite widely, and it therefore requires access and capabilities, developing capabilities to use a variety of tools. And that's kind of what we're seeing, where the ESG more broadly, the materiality of it can vary depending on the sector a company is in. It can vary depending on the region it's in. From a physical risk, that's obvious, but even from issues like the regulatory pressure to change a particular social behavior. And sometimes it can be entirely idiosyncratic. And so for us, given that our investment professionals don't study how to incorporate ESG in business school or when they were taking their finance classes, it's about us making sure that they are equipped with the latest tools in their current jobs. And that includes everything from, at a very simple level, understanding that it's about pricing and these risks and opportunities. The data is not always available, and part of it is therefore having a very clear sense of what data is available, what you are imputing, what assumptions you might therefore put into your model, and in your model, what are you playing with? Whether you're playing, doing some kind of a mega trend analysis that you think might impact the competitive moat of a business, or you might be doing something more sophisticated where you're doing a scenario analysis or a bear case kind of sensitivity analysis on a particular line item to say, how resilient is the company's EPS to this specific change? And in some cases, you may be able to actually go all the way down to projecting how future CapEx might be higher in the case of, let's say, increased capital expenditures on data privacy and cybersecurity, or increased capital expenditures to protect physically your assets if you happen to be in a flood-prone zone. In that case, you have a very clear sense of that increased CapEx that's going to flow through to then your projected cash flows and therefore impact your target price. So I think it's about it requires a level of sophistication, it requires a level of contextualization, and it underscores why this work should not be done by quote unquote sustainability people, but it should be done by investment professionals who can contextualize the data that they're seeing and actually have it flow through to the investment analysis that is being done. One kind of additional point on the data in and of itself, I think we all can go on kind of ad nauseum about the dearth of data and the dearth of consistency in data, but we have to remember that from a timing perspective, we are kind of where the world was pre-SEC for financial regulation, where there was no FASB, there was no sense of if you said EBIT and I said EBIT, we knew exactly what we were talking about. That's where we still are with in kind of the ESG land. There aren't clear definitions and there aren't clear metrics. There's a really interesting paper. I would urge anyone who wants to go into a lot of detail about the challenges with ESG data, some of which we are discussing today. But Professor George Serafem at the Harvard Business School wrote a paper called 4 Things No One Will Tell You About ESG Data. In that paper, for example, he talks about the 20 different ways companies will just report on health and safety data, using both different terminology and different units of measure. So for example, you might have a lost time incident rate, which could also be per 100 or per 5,000, a lost time frequency rate, injuries related in lost time. All of these things will be mentioned via numbers, some in ratios, some in percentages. And when you look at those metrics, they're not all measuring the exact same thing. So if you're trying to assess which companies are leaders or laggards on that particular issue, you're working with kind of essentially different distribution curves, for the same for that same topic, as opposed to having a sense of what the universe of measures are to then figure out where that company is on that distribution curve. So because there are so many distribution curves, it gets quite confusing. And I'll kind of stop there, but there are multiple examples of that variety and inconsistency of data and its measurement. Abby, you might be on mute.
Yeah, Abby.
Thank you. Yeah, I think Nikita made a really valuable point there, that it really shouldn't be just the sustainability or the responsible investment team who are looking at this. If that's the case, then it's never going to be an effective part of an investment strategy. And the role of sustainability or responsible investment team in an organisation should really be to set out the trends, to identify the sources of data, and to provide a framework by which all investment professionals can start to deepen their knowledge and understand what these issues are, so that they are able to take some of that contextual information that Nikita was talking about and ask the right questions when they're doing their underwriting or when they're doing their due diligence, because that sophistication of understanding is what's going to make the difference between understanding how these factors can impact on value or not. So that will be the key difference. And certainly for us and many of our peers, what we're focusing on is really starting to go down that process of deepening the knowledge and understanding of all of our associates across the board on what sustainability means and what responsible investing means, and the information that they need to know so that they can really go into that level of depth. And I think the level of knowledge has picked up hugely in the last few years, but certainly there is still some way to go.
Yeah, I might just add on to that. So I share that viewpoint that you've both expressed, and also we have this different perspective in that we speak to sort of dozens of different investors who are asking these questions. And what's been interesting there is to see this conversation move over the past couple of years so maybe it is still typically somebody with ESG or sustainability in their title who makes the initial call or email to us. But more often than not these days, we find we end up talking to the chief risk officer or chief investment officer, because this conversation is no longer a corporate social responsibility conversation. It's moved to business critical. People understand the materiality of it and how much it matters, and we've seen that transformation over the past couple of years.
Yeah, I completely agree, Joey. In fact, that's kind of where I was just thinking could be an interesting discussion to have about where this space has emerged from, and perhaps the resulting confusion, therefore, in the space. We started out in that SRI world of sustainable, socially responsible investing in the 70s, where a lot of it came from faith-based clients and was therefore steeped in kind of a certain moral and ethical perspective and catering to multiple stakeholders regardless of financial materiality. And I think where the space is evolving to is the idea, and to some extent already has, is the idea of ESG integration being really the incorporation of material risks and opportunities into your investment analysis, as opposed to some kind of ethical or moral judgment. But because of this, we're all aware of this evolution, the data is still kind of serving both audiences. And so you have this deluge of data that is not steeped in financial materiality, that is often, if you look at the CSR reports of companies, they are catering to both ESG audiences and SRI audiences. And sometimes they're also other stakeholders. And so there is that results in that inconsistency. The piece that, and it gets exacerbated further down the value chain when you have external ESG ratings companies that are then using that variety of data and kind of layering on their own, subjective analysis. So I wanted to kind of actually spend some time talking through and hearing, your opinions about that, because there's a lot of research out today showing how the correlation between two of the largest ESG ratings companies is 0.3 to 0.5. When you look at the correlation between a Moody's and S&P bond rating, for example, it's closer to 0.8. And I think there are a variety of reasons that come from the imputation methods, the benchmarking techniques that are used, and also the lack of contextualization to, understanding if you're looking at a business, is the appropriate sub-industry that you are assuming, the benchmarking for, or the imputation technique for, appropriate in the first place. That one can argue a fundamental analyst is much better positioned to do than a, somebody who may be an expert in water scarcity but doesn't understand how to bring that through to the impact on a global beverage company's revenues or margins.
Yeah, great points, Nikita. So I guess, so I fully agree with it, and there is just a diversity of different types of data out there. A lot of it is subjective. I'm conscious of sort of staying in my lane here, because I don't work in the broader ESG space, and I focus very much on climate risk, and that's a relatively new field, so it doesn't carry that legacy, and it hasn't had to serve both audiences. It is very much sort of, we're risk professionals, so yes, want to make the world a better place, but want to work with capital markets to do so, and so we understand it. So a good example here, I guess, is our director of research, who joined in January, Dr. Threes Feng, spent the last 20 years working for Morgan Stanley and Fitch and Jefferies, but prior to that had done a PhD in environmental economics at Yale. So after 20 years in finance, recognizes that there is a need for her skills in this area now, and can apply those, that sort of risk architecture experience, stress testing experience, and that has been, I've seen more and more of those types of people and careers shifting into this space now, because it's now sophisticated enough to kind of need those skill sets, whereas previously it really was very subjective, I think, and there was a lot of data, as you say, just completely inconsistent, bringing it all together. So it was probably better than the counterfactual, better than having no data, but it certainly didn't live up to the standards that we would all expect when we were sort of what we would expect for investment decision making.
I think part of the challenge is there is just when you're looking at ESG ratings, there's so much in there, and organisations can perform well in one area and less well in another. And when you're looking at a rating, I think it's obviously important to understand what it is that's being rated and how those factors are being brought together, which goes back to some of the points that we were making before about the importance of context and the importance of going a little bit deeper and bringing that greater level of sophistication to it, rather than maybe blindly relying on those ratings. I think we all agree is a significant factor, and I think really, what we found is that recently going back to the climate change data piece, that things like the TCFD, the Task Force for Climate-Related Financial Disclosure, have brought a really useful perspective on how you look at that kind of risk in depth, because it takes it from that this is good, this is bad, to how are these risks going to play out, and how might different investments, whether that be into a company, into a bond, or into a real asset, how might the physical impacts of climate change and that shift to the low carbon economy, how might that play out on these assets? So for me, that is a really valuable way of looking at it, and I think if we could bring that to some other areas of ESG, that same kind of scenario approach, then that would be very valuable. Dominic, I wonder if, given that we're talking about how ESG actually impacts on investment decision making, it might be a good time to go to, I think we've got a poll question on to what extent ESG is being factored into investment decision making now for the participants. So it might be interesting to get their feedback on that.
Yeah, great.
And certainly, I think we have seen that this has risen up the agenda in recent years, and it would be interesting to see if that's the case more broadly. But certainly, as I think we were discussing at the beginning, that there is more focus on this in some jurisdictions than others, and probably some way to go in some parts of the world.
Yeah, and I mean, I think also as people are kind of filling in their views, I'm quite curious to hear the response to this one. But I think that often for people who are early users, it's important to distinguish between ESG raw data that you are getting, from companies, that publicly disclosed data, and ESG ratings. And in our very often the two can be conflated, and as we kind of have been discussing, the minute you kind of layer on an additional subjective assessment by a firm that may not be necessarily, being accurately contextualizing the data to that company, the region, or the industry that the company is in, we can run into kind of multiple then layers of errors on judgment on that topic. So I'm one of the pieces that I was thinking that we should spend some time talking about is why these ratings companies tend to be, tend to have such different views on the same company. And in my mind, I think two of the biggest reasons is one is the benchmarking. If you're trying to assess, how well a company is doing on a particular topic, so let's say it's data privacy and diversity being two different areas, we don't have a sense of what the absolute range should be for a company, right? So we currently don't have we probably should on diversity to say that it should be 50% of let's say a leadership team being diverse, and maybe picking a specific diversity metric like gender. But today what happens is companies are reviewed in comparison to a certain peer group and that benchmark, and because different parties will be determining the benchmarks differently, that results in varying ratings. So even just at the industry level, some use GICS, some use BICS, which is the Bloomberg, some use the MSCI IBA. All of that kind of results in a different relative performance of a company. And I would argue perhaps we should move closer towards kind of industry peer groups rather than those kind of universal peer groups, because once you have those universal peer groups, there are going to be industry level biases that come into the ratings. So, oil and gas companies are always going to perform lower than financial services companies on an environmental, any kind of environmental metric. But you have to assess how material is the environmental metric to that company, and also, relative to its core peer group, how are they performing? So if you are using ESG ratings, it's important to understand the methodologies that these ratings companies are employing, and kind of really digging in and asking those questions so you're clear about what is the input and kind of what is the output. And A second piece I think that I would say that's quite important to understand is the imputation methods that somebody is using, because the data is extremely sparse. I mean, to give you a sense, Joe, you may know this better than me, even something as simple as Scope 1 emissions that we think is, relatively easy to calculate should be disclosed. I think the coverage ratio, when you look at for the broad industry, let's say 12,000 securities, it's less than 70%. And most of these data providers are sharing 90% plus coverage of something like Scope 1 emissions. You can only imagine what it's like for social data. What they're essentially doing is imputing what that value is based on something like a GIG score classification. That this company happens to be a turbine manufacturer. I'm going to fit it in with other turbine manufacturers and assume that they're going to have a similar Scope 1 level of emission. And so that kind of estimation, it's important if you are delving deep into ESG data that you understand the imputation techniques that are being used. They might be rule-based. They might be kind of an input-output model where, depending on the relative footprint or size of operations of a company to the greater industry, they could be more sophisticated using like statistical methods like regressions and predictive mean modeling. But again, there's a lot of research showing that, that those kinds of models come out with very different values than for the known values that we already know for a company on a particular metric. So I would just caution people who are interested in swimming in ESG data and trying to make it valuable, that it is extremely nuanced, and you have to kind of dig deep and make sure you're comfortable with the underlying methodologies used.
Yeah, sorry, go ahead, Abby, go ahead.
I was going to say, I think that what's really important is to identify the key issues that are significant, and then to build a picture of what is good enough and where do we want to get to, what is the absolute best practice. Because without that, it's very difficult to actually judge how a company or another investment is doing. So, you can produce a wonderful report showing that you've done some good things, but compared to what is the key question, and is it good enough, and is it getting you to where you need to be? So a good example for us is we have made a commitment to net zero carbon buildings across our portfolio, and to be in line with the Paris Accord, we know that buildings must be net zero carbon by 2050. So that is and for some markets we're going to need to get there a lot quicker than that, but that is a useful end point that we know we need to work towards. So therefore we can judge investments in buildings against that. And I think we can start to develop those similar gold standards, as it were, in different areas as well, in relation to diversity, in relation to workforce, in relation to a range of different issues. And then if you can be clear on what that is, then it's much easier to judge performance against it, and also to understand how quickly you expect investments to be moving towards that sort of gold standard. So that I think that being clear on what the end point is really important.
Yeah,
I'd jump in, sorry, actually, for a second. I've been jotting down the questions which have been coming in, and pretty much as soon as I jot one down, you'll have answered it anyway. So thank you all for such a good discussion. But there's a couple that I'd like to double back to, because we're getting quite a few repeat questions on them. A lot of them around sort of reporting schemes out there, SASB, GRI. Are these sort of, what's their role in clarifying and enabling comparability between data? Is it possible to build a standardized global common ESG framework? That's one side of the questioning we'd like to get to. Also, the other side would be around the communication. How do we communicate our findings, our understanding, our interpretation? How do we communicate this again across to end users, to your clients, and also to the corporates as well?
Can I give a very quick answer on this? I'll be really quick on the first part of this about the sort of alphabet soup of different standards and frameworks and guidelines and so on. One of our partners is the AICPA, which is the most influential body of accountants in the world, and I'm certainly not speaking on their behalf. But I think that they and others have been really clear that there needs to be a sort of a standardization across the board here. There's far too many different standards out there, and I don't see a world in which they don't all sort of start to, not all of them, but several of them that overlap start to merge together. There's difficulties, I think, short term to make that happen, but they're tactical, and I think it's clear to Nikita's earlier point about where we were sort of pre-SEC and everything like this. We're going to get to a point where standards start to become clear, people start to drift towards the most appropriate ones and the best data providers as well that comply with those. So yes, I see that as a one-way street. I'll stop there.
I completely agree with Joey that I think there will be different frameworks, perhaps regionally. The way we've ended up on accounting, there's IFRS, there's FASB, and many other regional ones as well. But I think that the direction of travel seems a bit more clear with organizations like SASB. Lazard is a big supporter of SASB. The integrated research kind of framework that we have developed internally is based on the foundation of SASB. And I think what's particularly unique to what they're doing is that they have that intense focus on materiality. They had, industry level discussions with corporations, with asset managers, with asset owners, kind of everyone in the value chain to debate what the most material issues are, and then have suggested, key performance indicators for each of those 77 subsectors that have material issues listed. So I think, not to say that SASB will be the definite winner, or there might be other organizations, but the framework that they are kind of basing themselves on, to me, makes sense from a direction of travel. There was something else that you touched on. I'll come back to it.
The one additional point that I would make is you asked a question around the reporting of the communication of this kind of information out to clients, and I think that what's really what I would say is that it's really important that this information is integrated into the more standard communications that go to clients, and I think that's true for reports from asset managers to their investors, and also for companies. I actually think it's more valuable to have information integrated into a report rather than necessarily always having a standalone CR report, because this really does need to be all looked at in the whole and not separated. So I think that if indicators in line with the SASB framework and also GRI can be really helpful for consistency, can be incorporated into more standardized reporting, then that's useful, and that really focusing on those key material metrics rather than producing reams and reams of anecdotal case study type information.
Yeah, I mean, I was thinking in terms of, what can be done to start to chip away at some of these, challenges that we've shared today. I think it's kind of three areas. There's the at the company level, Abby, as you were saying, it's making sure that these issues are, if they are genuinely material, then they should be alongside other material disclosure, which is your case cues within your risk section, within your management discussion and analysis. And I think on the company side, the request from us as asset managers is always to, you need to take control of your ESG data narrative. You need to proactively kind of shape your disclosure rather than being overwhelmed by kind of the survey requests from all the ratings companies. You need to think about and talk about what the most material issues are and what are some consistent metrics that you can report year over year that also help us compare you to peers. That's when we know you're serious about it. And I think there could be also more work done maybe by stock exchanges who can consider, issuing or maybe even mandating guidelines for what ESG disclosure should be. And this can obviously be with collaboration of everybody in the value chain, including regulators, but I think stock exchanges can play an important role. And lastly, it would be a a strong plea to data providers and ratings companies to spend some time trying to agree on what best practices are, and if they can be as transparent as they can about the methodologies that we kind of discussed in detail, including what I think what Abby said. She kind of hit the nail on the head, having a sense for what the predefined ranges of performance are. And when you're trying to measure to net zero by a certain date, and I understand, it's much more complicated beyond real estate might be a relatively easier sector, but Joe, you could speak to, sector decarbonization pathways and how those can also vary quite greatly. But for us to start to have a sense of what the range of performance should be, then there'll be a better absolute assessment rather than, running into all the trouble that we have with relative assessment of performance.
Thanks, Nikita. You just moved on to what I was actually going to ask for there, which was a call to action for the final sort of minute or so that we've got left. Just before we go to that, actually, there's been a few requests for the Harvard paper that you mentioned, Nikita. What was the title and the author that you mentioned?
It's co-authored by Professor George Serafem, and it's called, I'm just trying to look through my notes for these, 4 Things No One Will Tell You About ESG Data. It's written alongside his consulting partner, Sakis, apologize, I can't pronounce his name. It's a long Greek name, but the 2 gentlemen are kind of co-authors of the paper, and it goes into a lot of what I shared today. I think they really have a strong understanding of the limitations and the opportunity and the potential for ESG data.
Perfect, thank you. So I'm going to launch the final poll, which I think ties in quite nicely with bringing a call to action. So if everyone can give a final few thoughts and something that we can all do to help progress and help better use ESG data. Joey, perhaps you'd like to go first on this one.
Sure. Let me start by sharing the mission of the Climate Service, I guess, because I think that puts it in context. And we've talked a lot today about putting data and things in context. Our mission is to embed climate change data into every financial decision in the plan. We believe that when it becomes more transparent, the sort of risk and opportunity from the changing climate and the move to a lower carbon economy, it will accelerate that move to a lower carbon economy. So I guess my call to action, as you put it, Dom, is for people to start on that journey. Climate change data is, as I said earlier, it's the largest idiosyncratic risk that's left largely unmeasured by markets at the moment. So there's an opportunity there in moving quickly to capture this type of data. And just with the words of Sarah Breeden from the Bank of England, she recommends people start off with an English paper and move over time to a math paper. So start dipping their toes in the water with sort of qualitative assessments and moving over time to a more robust quantitative assessment. So everyone's on a journey here, and nobody knows all the answers at the start. But if we can support anyone on that journey, then we're always happy to share our experiences in this area.
Excellent. I'll just share the results of that poll. And Abby, would you like to give a call to action? Final statement?
Yeah, sure. I think mine would be to focus on embedding responsible investment throughout all organisations and a good understanding of ESG and sustainability issues. So to really focus on making this mainstream, to recognise that everybody in an organisation needs to understand the key issues and to ensure that that's being integrated into all investment decision making, and it's not just being looked at by a RI team on the side.
Excellent. And Nikita, I know you gave a few call to actions before, but any sort of final closing statements, and then we can wrap up.
I totally like what Joey and Abby, what you said. I guess the one thing would say is to not be overwhelmed by all the challenges that we share, that we've shared today, but to rather think of it as perhaps one of the greater opportunities within the investment industry today, especially in asset classes like public equities that are fairly efficient. This is a great opportunity both to demonstrate what good investing can be, but also to honestly advocate for and affect real change, because when change is embedded into financial analysis, that's when you also can find the change to be more sustainable.
Fantastic. Well, I think we're about out of time now, but this has been a really engaging discussion, and I can see from the audience, participation that and all the questions that I've received that everyone has been engaged as well. For the questions, I'll try and get the ones that we didn't get to across to our panelists today, and if they can perhaps take a look at them and maybe answer a few, I'll release them when I send out all of the recordings later this week. But thank you to our panelists, Joey, Abby, Nikita, and thank you everyone for tuning in live.
Thanks so much.
Thank you. Bye.